Hello and welcome to the 2021 Northern Virginia Housing Expo. This year marks our 11th year of offering education, resources, and connections for those interested in housing issues and affordable housing opportunities in Northern Virginia. Today's workshop topic is Hot Summer Mortgage Programs. And our presenter today is John Melnick, a senior loan officer from Presidential Bank Mortgage with over 30 years of lending experience. Today, John will share information on the advantages, requirements, and stipulations of special current mortgage programs offered through Home Ready, Home Possible Advantage, and Virginia Housing. If you know someone who wasn't able to join us this morning, please let them know that a recording of this webinar will be posted to our Facebook page at 2 p.m. If you have a question, please click the question mark button on the right side of your screen and type your question there. Take it away, John.
Thanks, Cameron. I appreciate being on the Home Expo program. I've participated in the past, and I think it's very worthwhile information for buyers as they prepare for home ownership. So you can see from my front slide, I'm titling this Hot Summer Mortgage Programs, but of course they'll still be hot when we move into fall and winter. So these programs will be available. There's changes that happen along the way, but what I'm talking about is the Virginia Housing and Development Authority program and tying it together with the Fannie Mae Home Ready program and Freddie Mac Home Possible Advantage. And they're really very similar because the VHDA program is really a home ready mortgage, which at its purest is a 97%, 3% down conventional program. The VHDA has some special guidelines that go along with it. And then Home Ready and Home Possible Advantage have special guidelines that go along with it too. I'm going to click this here. And so to familiarize with the programs that are out there, if you are new to home ownership, or in the case of the first programs, Home Ready, that are going to also own a home, or currently own a home, but you're buying a new principal residence. The key here is all these programs require only finance a residence. They don't finance a second home. They don't finance investment property, just your residence. But Home Ready and Home Possible Advantage, there's a way you can still own another home that might become a second home or investment property. VHDA does not allow that. So, and you'll see it. So this is really stripping it out. And if you don't have Home Ready attached to it, this goes nationwide. So I'm in Virginia, and the Virginia Housing and Development Authority program is for Virginia property. So anywhere in Virginia you buy, VHDA or Virginia Housing is going to work for you if you meet other eligibility. The Home Ready and Home Possible Advantage could be used all over the country. There's not a state-specific restriction, but each state may have its own version of the VHDA that they add to this program. So it's a good one to know about. And the main thing is not thinking that you have to have 20% down to buy a home. The main thing is that keeps people from buying or delays them is saving for down payment. And that's the main driver of these VHDA and Home Ready programs, is to be eligible to buy a home sooner than later and not miss out. So Home Ready, Home Possible Advantage, we call those agency in the business, Fannie Mae and Freddie Mac. Things are, changing all the time. The outlook is optimistic. It seems like with the rates staying at a lower ranges for longer, and these programs are being looked at and maybe expanded. So the key driver is income. So if you're beside buying a residence, it depends on the area you're buying in. And there's a map. You can look it up, Home Ready income limits by property address. And they have this nationwide map, and you put the address of the property in that somebody wants to buy, and it tells you what the maximum income they can have if they want to use this program. And around this area, we're in a high cost loan limit area, so probably the highest, one of the highest in the country. So it's $102,250 annual income a year to get these benefits. Otherwise, if you make more than that, and the other thing that's important to know is this program, if somebody was married or they had other people in their household that have income, they only use the person applying for the loan if it's Home Ready or Home Possible Advantage. That's pretty key for eligibility. They could have another person making money, but if they're not on the loan, they could be on title, and it doesn't disqualify you for income. So 102,250 in the DC metropolitan area. Can't own another home and meet the income requirement, then you have these expansive guidelines. And it's different than if you do a regular conventional mortgage. There's also, of course, FHA mortgages, there's veterans mortgages, USDA, rural housing for different areas. So all those things. This is the nationwide first new home buyer program. So they really give you a lot of leeway in your debt ratio. And there's changes that are happening about the debt ratio and a qualified mortgage. That's something lenders have to meet the guidelines for. But this 50 debt ratio is the highest that's typically allowed. And some people are right at the edge of it. But this is pretty expansive. The VHDA program is 45. So you can see somebody could not qualify for as high a sales price or loan amount under VHDA as with the Home Ready program, because you got this 50 debt ratio. The key thing is that there's not other drivers in the loan that raise the risk. It's the 640 minimum credit score. Those are the FICO, their ISIC credit score. And you have to have a credit score to be eligible. At this current time, 640 is the minimal score. And lenders look at 3 scores, typically Experian, Equifax, and TransUnion. So it's important to get an idea what your credit scores might be. And this is pretty universal. Some might be, higher, some might be lower, but 640 is an average. It's what Virginia housing, their minimal is right now. Non-occupant borrowers, can't do that with Virginia housing, but with this program, if you put 5% down, you could have a parent or close family member borrow with you and not live there in the property, and that's a key thing. The other flexibility that happens is if you currently have somebody that rents from you, like rents a room, and you can verify when they started renting by ID or something like that, and then the canceled checks for rent, then you can add that as income as a percentage of it. So very unique, that feature. I've used it before and it works. The tenant room or income, but they have to have lived there 12 months, will continue to live there, and you have to document it. The program's good for purchase and refinance. So I do have people, key driver, again, income. If their income meets the limit and it's a residence, then you could refinance with it. And one of the key things is rates are lower for this program. And also the mortgage insurance that required, if you put less than 20% down, is less. So all in all, you get a lower monthly payment with the program and lower cash investment. Program nationally right now goes to 548,250. That's what they call the conventional conforming loan limit. So if you looked at that and you had the 3% down, that's going up to a sales price of roughly $565,206. So you're good up to 565 and use this program if you meet the income limits and other eligibility. And Freddie Mac lets you finance multi-unit properties. So this program, again, more expansive. The key thing is if the person has sufficient cash to do the purchase. And so you think, okay, well, what if we do this example? And I've got an example of 525,000 sales price. The down payment is 15,750. This is not written, but I'm just gonna mention it. If the seller will pay your closing costs, they can. That would be your minimal cash investment, 15,750. If the market turns, it's been more competitive in the DC metropolitan area. Real estate is very much based on location. So other areas, if there's more houses on the market and sellers are competing for buyers, then they could be incentivized to pay your closing costs. If not, then the total investment is about 26,657 under this type of program. And what's allowed is for you to use your own money that you've saved, and the lender looks at 2 months of bank statements. So that's got to be pretty straightforward that you've saved it. No cash deposits or in that time. It could be given to you by your immediate family, so you can get a gift from a blood relative, and that's acceptable for the down payment and closing costs. And you could use your 401k or your retirement account, and you could borrow against that. That doesn't raise your debt. So all those things are possible, and of course the seller could pay the closing cost. So that's the one of the key things is, can you afford to put that money together between $15,000 and $26,000 to make that happen. Let me go to the next slide.
Hi, John. Sorry. Before you get to the next slide, we had one question come in, and she just wanted to know the name of that program.
The name of that program is Home Ready, and that's the Fannie Mae version, and Freddie Mac is the version of Home Possible Advantage. And they're very similar. There's some nuances that a loan officer would know about, but very similar type programs. So that's, and it would be, a lender would call it a conventional loan.
Thanks so much, John. She thanks you. Thanks, Candy Lee.
Oh, she's welcome. Key things, again, just to, draw it out. Very important before shopping for a home, and I say 30 days to 60 days. Make sure that a lender reviews your financials and get you pre-approved, and then you can make your decision about the lender once you get a contract. But that's a key thing, is to get pre-reviewed, pre-approved, and then the eligibility for these programs can be determined because you don't know it all up front. There's multiple things. So the income limit, 102,250, we've got the highest in our area, and that can be the applicant or the household if it's Virginia housing, which I'll cover in a minute. Loan amount, 548,250, so you've got the ability to buy up to 565 sales price. Properties acceptable, detached home, condo. Condo needs to be warranted by the lender, but that's usually okay. Townhome, with a homeowners association. And if you're buying multi-unit, which is not as typical, but you have to put 5% down, you can't do 3% down. I'm going to click the slide. Mortgage insurance, the key thing is to drive the payment down for the buyer as low as possible. It is credit score sensitive, but it takes away some things that if you are on a regular conventional program, if you had lower credit scores, let's just say below 700, and especially below 680, the mortgage insurance and the rate could be very much higher. And it might be more appropriate to use FHA with that. Those are the things that a lender can determine. But if you have a credit score over 700, then you get the best pricing. But the amounts that the rate or the mortgage insurance would go up are greatly reduced under Home Ready and Home Possible Advantage. So another key thing about the program, lower rates, lower payments, and lower mortgage insurance cost. Mortgage insurance on a conventional loan does go away down the road. So once you pay the loan down to 80%, or you could have a appreciation do it for you, but you could get it removed, and then it goes away when the loan hits 78. So FHA is life of loan. Veterans has a funding fee. USDA is similar, where you pay an upfront fee. But the conventional, again, Fannie Mae, Freddie Mac, the mortgage insurance is not permanent. It goes away down the road. And then better, more expansive on the ratio. The 50 ratio is an exception. So I have had clients that we used the program, we were trying to do 3% down, but they had a lower credit score, maybe a higher ratio, about 45, but under 50. And it didn't accept it to do 3% down, but it accepted it to do 5% down. So sometimes it'll take just more flexibility, but it doesn't do it above 45 ratio. But 50 is available and that's a key driver. I'm going to click slides here. We've talked about border income, very unique. You have to have the person documented that they've lived with you for 12 months, but that could be income. Homeownership education. These programs require an online course that you take during the loan process. You can do it before you buy if you want, and the lender you're talking to can point you toward the correct one to do. People tell me they take anywhere from an hour to 4 hours, depending on, but it's something they do during the process, and they have to do it prior to closing on the house. And at the end, they give you a certificate you just print out or keep as a PDF. And but homeownership education for any of these eligible programs is online, is required. And then you got to have the 640 credit score. Something a review can help you with is if you have a score that's close, but just under, then the lender can figure out how to help you raise your score. And if there's a way to do it, then we try to give that kind of advice. And then the person typically is paying down a credit card balance, and then we are able to get a score that meets eligibility requirements, and they can buy a home with that. So that's part of it. All right, now we're in Virginia Housing, and if you look online, it's VHDA.com, but they changed their name. They made it just Virginia Housing officially. So think of this. The reason I did the Home Ready and Home Possible Advantage before is this is really a Home Ready loan, all its requirements and the way it ends up, but it does have the state bond program above it. And Virginia Housing is a nonprofit in Virginia. Again, you got to buy in Virginia. So if you buy in the District of Columbia or in Maryland, they have their own programs, but this is not, what it is. This is the Virginia program. So you have to prove you don't own a home, because remember, this Home Ready, you could still technically own a home as long as you're buying a residence, but this is no home ownership, and it's verified through your credit report showing no mortgage, sometimes tax returns, showing no mortgage deductions, but you can't have owned a home the last 3 years. And then you got to meet those income requirements. Technically, when you look at their guidelines, their income limits are higher than 102,250. But what happened was the other year, they changed in all the benefits of the program, being able to use the grant, use second trust, you go away and the rates go higher if you have income over 80% of the median. So we're back to this program requires 102,250 in the Washington, D.C. metropolitan area, Virginia. But different counties in Virginia have different incomes. So that's why the lender has to look it up, because if you can buy all over Virginia, but they have different income caps. So you have to put the address in to get that. All household income. So if the person's married, you have to find out what their spouse is if they're not on the mortgage. That wasn't the case with Home Ready. It was just the applicant. But everybody in the household, you have to use their income. So if the person makes almost 102 and they have somebody else making income, that could make them not eligible. So that's, again, the lender determines that during the mortgage review to make sure that there's not extra income that would knock the person out of eligibility. Again, then you could switch over to Home Ready and be just one person. Income debt ratio. We talked about Home Ready already being 50, which is pretty expansive. This is 45, more conservative. So a person who's maxing out on their qualifications is going to get more loan with Home Ready or Home Possible Advantage than the Virginia Housing Program, because it's capped at 45 debt ratio instead of 50. And they're very strict about that. You got 640 credit score. Another thing about it is they don't like you to use your home in a business or trade, and that's tricky with how people during the pandemic have been working at home. But it's the amount of the residence. So as long as the person's using less than 15% of their total area, which is probably more typical, they can use it they can be working at home. But the lender needs to look at your tax returns just to determine if you're self-employed, if there's any issue there. Nobody else can borrow with you that's not going to live with you. You get to purchase or refinance. Their sales price is less. It's $525. So you can't buy a home up to $565 with this, like Home Ready. You can't. You have to cap it out at $525 at this time. Sometimes it changes, and it could change this year, but at this time it's still $525 for the sales price for a Virginia housing. And why would lenders look at this program? So the reason that you use it, let's see if I hit this here. I'm gonna get back. Okay, I'm gonna have to. Okay, go back to the one of the slides. The reason people would use the Virginia Housing Program when we flip over to it again is that there's one program that's a grant. So the grant is up to 2% of the down payment. So think of your Home Ready, you got 3% down usually, which is the $15,750. You can get $10,500 of it in a grant that you never have to repay. And that's very attractive for a lot of people. And if you've got some savings to pay the 1% down payment, if you're lucky, maybe the seller can still pay the closing cost. But if not, then of course you're getting a grant for 2% of your down payment. So you got a 1% down loan. Again, this grant is given as a gift from Virginia Housing, and it comes in on your closing statement like a gift. And it's not repayable, so you don't have to make a payment on it, and you don't have to pay it back. You just have to be buying a principal residence. So it's a pretty good deal. There's an affidavit for VHDA that you sign that has more specifics. But the grant is one key feature why somebody would use the Virginia Housing Program, is for the grant. And it's under their programs also include FHA, veterans, and the USDA rural housing. And if it's a veterans program, veterans, they get to buy no money down up to no limit, technically. But since they get no money down, they get a grant to help them with their closing costs. So there's up to a 2% grant for veterans getting their closing costs. So don't think of this, even though we're mostly talking about conventional loan programs, Virginia Housing could also assist with the veterans investment and also the FHA and rural housing. The other huge thing that VHDA offers is a second trust. And the second trust can either make it a no money down program, but as long as you've got at least over a 660 credit score, then you can get another 1.5% of the sales price toward your closing cost. So in this case, you're getting 1.5%, so another $7,775. What I found when people use the second trust program, so this is a second trust, you have to pay it back. It's part of your monthly payment, includes the payment on the second. And the interest rates overall, what I found is VHDA has slightly higher rates than market because of these grant and second trust features. Not much, but just slightly higher than Home Ready or Home Possible Advantage. But these are for folks that really need either the grant to reduce their housing investment, or they need the second trust, which will reduce their investment to really about 1% of the sales price. And that's the other key requirement, that you have at least 1% of the sales price in your savings, or it could be also from a gift. So that's the Virginia Housing Program. It used to be like these programs, and we'll bring it all back for what they are and how they're done. These programs sometimes had to be underwritten by the authority. So you had to send a Virginia Housing Program to Richmond to get it all approved. Now we're delegated. So we're delegated to underwrite it and process it and close it. And that saves a lot of headache, and we control or the lender, when they're delegated, controls the customer service with it. So you don't have somebody else. It's not like a brokered loan. So it's as long as you're meeting the eligibility requirements. One of the key things is when you're in your preparations is looking at your future income increases, because on Home Ready and also this Virginia housing program, in the DC metropolitan area, somebody's income might be right on the edge of that 102, 250, and they might be eligible for a raise coming up. It always happens at the beginning of the year usually, but the person has to make sure they don't all of a sudden before closing get a re-verification, and all of a sudden they make more money than they're supposed to, and they're not eligible anymore, because then you'd have to go back to standard program. Because again, the key driver is this income being 80% of the median for Home Ready, Home Possible Advantage, and Virginia Housing. The other things that happen have to do with looking at funds, and again, they're very flexible. All the programs are about your savings, gifts from family, immediate relatives, and also your 401k. So people sometimes have more in their 401ks than they imagined, and that's not considered a debt. So it's the housing market, possibly becomes more favorable for buyers, then the more these programs are really are a benefit of buyer's market, because we all know that real estate has been not as many listings and more competitive for buyers, and causes the prices to go up. That still happens in areas, but these programs, the way that they're capped out sort of in their how much they lend. Remember, Virginia Housing can't buy more than 525,000. Some areas the houses are more expensive, so it works well in city areas for condominiums. And right now, the market might be better for that kind of property. So that's just what I'm hearing is that, again, if you're buying closer to the city and you want to use one of these Virginia Housing or first-time homebuyer programs, it might be a little easier to be the buyer now if you're purchasing a condo property type. The townhouse and the detached homes are still, the listings are low. So it's a little bit more competitive, and because you're coming in with little or no money down on these programs, somebody buying all cash is going to look more competitive. But things are changing, and so that's why this is really good to know about, because it keeps you from having to wait, because on average home prices have been going up more than usual. Usually you say 5% or 10%. So the home that's 525 this year could be 535, 540, 550 next year if there's a shortage of inventory. Home prices also go down. So when you buy a home, you're taking on some more responsibility. That's where we circle back to the home buyer education, because it's when you've been renting, if something breaks, then the landlord's fixing the utilities and things like that. They keep doing the upkeep of the home. When you're the homeowner, you're participating in the equity appreciation because you own it, and your loan includes principal and interest. So you're paying you're increasing the equity in your home every month that you make a payment. So then you're able to write off some things like property taxes. Sometimes mortgage insurance is a write-off. So you're getting some benefits when you net your payment versus rent. And because of that, you just have to be prepared. I think one of the really important things, if you can negotiate it in your offer, is to get a home warranty. And I see this all the time in contracts where that you get a home warranty. It's like an insurance policy, and it's for 1 year typically. Whether somebody continues it after that is up to them, depending on the cost of it. But sometimes the seller will pay it, and it protects you for a year if the furnace, air conditioning, other stoves, things stop working. So it protects you against expenses that you weren't planning on. When you buy a home, something else that happens is, let's say you're buying a home and you're going to close at the end of September. You don't, or any time in September typically, you're not making a mortgage payment in October. So you're getting to skip your next monthly payment. Whenever you close, think of the next month as a breather from your payment, and then you make your first payment 2 months or the month following. And with these programs like Virginia Housing, that's serviced by Virginia Housing. So they'll be the collector of your payment. Your payment, when I go through these, also includes taxes and insurance and mortgage insurance. And I went through, and just like with Virginia Housing, that sales price of $525, I would looked at, okay, well, how much is the total investment there? And again, it's purely $26,657. But you can see if you use the full VHDA with Second Trust, instead of waiting to save your $26,000, you can get in for roughly, $5,250. So that's pretty dramatic at the end, using their Second Trust and their closing cost. And if you meet eligibility requirements, their grant is like free money to buy a home. So that's a really special thing too. And it's the market maybe becomes a little bit more favorable for buyers. These programs really can assist more people, because when there's not enough homes to buy, but it's very competitive. It just doesn't come in handy as often. I'm thinking of other key things we talked about home buyer education, is being prepared to pay expenses when things break down. But also, like, what happens if you want to move again? And most mortgage programs, when you're buying as your residence, you need to move in after closing within 60 days. So some people have an overlapper that, it's kind of handy, if you close and then you could do your painting or whatever updates you want to do without, living in there. But also I have people that move in that afternoon, after closing. So it just depends on the situation. But at the settlement, after you sign and the seller signed, that your ownership, you got the keys, but the note will say that you need to move in within 60 days. Also, the seller technically could rent back and you become a landlord for 60 days. So that's just if somebody had another house to sell, it's a way that they could stick around a little bit longer to either wait for their house to be built or wait for closing on another home. But the 60 days is what you got to do. And you're supposed to live in the property for at least a year to be an owner occupied. And so things happen. So somebody technically could have a shorter residency, but typically it's a year. And if they wanted to keep the property to be an investment, have a tenant occupying it, that's the same deal. You occupy it for a year, and then you could move on and you could have an investment property. There's not a restriction with that. Virginia Housing has something else called recapture tax. It's unique to Virginia Housing because it's a bond program. So if you're going to try to get benefits from the grant or the Second Trust, then it goes for roughly 9 years. If you sell the home, then you have significant profit, and you also have had significant income. Your income's gone up an awful lot. There's a chance that some of the gain, and it's a small percentage, could be taxable, recaptured from VHDA. The thing about it is that very few folks have ever had that happen. So it's worth knowing about, but the way it's set up is not in a way that I've ever had a client worry about. When they see what their income has to go up and what the value has to go up within that 9 years, and after 9 years it goes away, the benefits far outweigh the recapture tax. Something else I wanted to mention is a benefit to Virginia Housing is the mortgage credit certificate. So mortgage credit certificate gives you a direct write-off of your income based on the mortgage interest that you pay annually. The current mortgage credit certificate offered from Virginia Housing gives you 10%. So, for example, with our 525 sales price from Virginia Housing, let's say you borrowed the max 509,250, and you got an interest rate of 3.25%. Your annual interest is 16,550. So you get a 1,655 deduction in your taxable income because it's a direct credit, which lowers your tax liability. And that's called a mortgage credit certificate, or MCC. It's unique to the Virginia Housing and Development Program. And you get this actual certificate. And what you have to do is you have to send evidence of it when you file your taxes. So I always try to remind people with the Virginia Housing that they have the MCC, and to remember it when they do their taxes, because it's something else that, you can see how this technically brings down the monthly payment about $137 a month once you take that tax write-off. So again, it's called mortgage credit certificate, and it's a benefit of the Virginia Housing Program. Another key thing to know. As far as a seller, when I talk to a seller about these programs, they being pre-approved and reviewed ahead of time is key. There's automated underwriting that goes on. So what happens is a lender, you're eligible, you're looking at buying, you can take an application without a property address. And let's say you're trying to get the maximum VHDA 525 sales price. It's just fixed, right now it's to be determined. And but we can take all the rest of the application information, including credit, assets, and it could be run through automated underwriting. And we determine that you're eligible for the Virginia Housing Program or the Home Possible or Home Ready Program, Home Possible Advantage, and we can set up the scenario. And again, you could always go down in price. So if it was VHDA that somebody was hoping to get the grant, hoping to do the second, we'd probably, and if they were able to qualify for up to the max 525 sales price, maybe they find a home that's 450 or 400. That's okay. You just use a bigger amount. So sometimes for the review, we try to use the higher amount that somebody might be looking at, and you can run the property address through with it to determine more qualification. But that's a key thing that sellers like to know. And you might be competing against somebody making a larger down payment. So the lender's talk, which doesn't include your private information, is key to explain these programs, because on the surface of it, it would appear that the person is getting, a high financing to the sales price. And you go, well, this is, they've been pre-approved, fully reviewed, all docs. This program's done in-house and we control it. And I wouldn't write a letter if we didn't think it was as good as cash. But you can see, you're getting a bunch of advantages there. The only thing the seller has to do different, in the old days, there might have been extra fees, is I tell the listing agent that the seller will sign an affidavit of seller, and it just says that the sales price is what it is. There's not extra incentives to buy the home, and that it is fully finished. The property doesn't, have extra value in there. And then you sign an affidavit too. Usually it happens once the appraisal comes back. So they require somebody to go out and look at the house, and that's something you pay for up front. But as far as the valuation goes, the sales price is what kind of rules the eligibility. So the seller just does this affidavit. I kind of make sure they know it up front. They're not surprised by it, but we just make sure it goes out, comes back. Yours goes out, comes back. You're just saying you're a first-time home buyer, verifying your income, no additional. When you buy a home, the home can't have things like a pool table or unattached things. Let's say like a boat or a car or something. Can't be part of the price or value of the home. If the person was, let's say they did have some furniture in the house that they wanted to, just keep, or you could buy it on a separate bill of sale. But the seller, the only thing they can incentivize you with on the contract is they can pay up to 3% of the sales price toward your closing costs. So if you buy up to this 525, technically they can pay up to 15,750. So you can see they can pay, you know, pretty much the whole amount of closing cost if you don't pay points. And when you look at the cost of the loan, the cost of buying a home includes your down payment, and then the financing has closing cost. And so those add typically, in this case, my 525 sales price example, the closing costs were roughly 10,900, and that included the loan, and the lender typically, discount points are extra points you pay, percentages of the loan to buy the rate down. Most people are just trying to reduce their cash. So, you know, looking at the loan that's not too expensive, no points is probably the way most people look at it. But then you've got typically underwriting or processing charges. You have to determine no floodplain, flood insurance. So there's some setup things. Then the title company is usually referred by your real estate agent. And I haven't mentioned realtors, but I think they play a valuable role in this process to guide you through the contract and help you negotiate the best deal and help keep it together during the process to make sure that the seller's meeting their requirements and you're meeting your requirements, and then keeping it together before closing and at settlement. So they definitely are very helpful in also reviewing the value in the offer these days. So the realtor typically refers to a title company, which is the same as a closing attorney. It's a place you go for settlement. So initially, a lot of these things now can be done by DocuSign, your contract, DocuSign, loan documents, the programs I'm talking about here, DocuSign initially. Documents can be sent, you know, electronically with we call it an electronic consent. Very effective systems now where you can trade information securely. But the closing has to be typically an in-person thing. There's not the virtual closings really haven't taken off in Virginia. It's state by state. So let's just say in the last month, they've allowed with safety measures like the realtor to attend closing, the buyer, the lender might attend to answer questions, and that's also where the balance for closing. You're like, well, how much money do I have to put out to buy this home? So the typical things you would have as a buyer when you put a contract on a house is you have a deposit, and that might be 1% of the sales price. Your realtor would advise you. That comes back to you at closing as a credit, so it's not gone. If you have a home inspection, you know, you might have another, you know, $200 to $500 for a home inspection. Some do, some don't. And then the appraisal for the loan, typically around $575. So those are some upfront expenses when you buy a home that, you know, you just have at the ready. And then the balance for closing is typically wired these days to the title company. And you have to make sure you don't get duped into sending the money in the wrong place and use your specific, you know, direct wire information. So the title company gets your money and they have to have it by the day of closing. That's one of the rules is the money all has to come in. And the title company releases the ownership of the seller and records your ownership. So part of it is your money, part of it's the loan. That's part of it. And with that, they transfer the ownership to you. So that's what the title company does, and they charge different charges for that, and then releases. And then there's this thing called title insurance. Title insurance is to protect the title if there was some problem with it, unreleased loan, some other owner that nobody knew about. Mortgage insurance, we already talked about. That would be if you put less than 20% down. And then you get your own homeowner's insurance. And homeowner's insurance is like for fire protection, mostly we check for flood, but it's mostly fire protection, weather related damage to the home. So you get that during the transaction. That's a prepaid. And then the county and the state also have it's like a sales tax. So when you buy a home, you pay sales tax to the county and state, and that's part of your closing cost. So that's why you've got this other, you know, 10,000 to 15,000 of closing costs and prepaids. Prepaids are odd days of interest. We've mentioned you skip a month when you buy a home, the cost of your home insurance, and then typically your mortgage payment includes taxes, insurance, and the mortgage insurance. And if you buy a condo or a townhouse that has a homeowners association, then you pay that separately. That is not part of your mortgage payment. So in this example of this 525, between the principal and interest and the home insurance, taxes, real estate taxes, mortgage insurance, the payment was like $2,931, and in my example. So I just kind of backtracked on what the cost was, and what a lender looks at for eligibility. Again, the first thing to do is when you think you're going to get serious about buying a home is to get the mortgage review. And as far as people worry about their credit report and credit inquiries, if you're shopping for something like a mortgage loan or a car, then mortgage inquiries or loan inquiries are not a big deal for your credit score. So even if you talk, let's say you talk to 2 or 3, that shouldn't affect your credit, having those inquiries. The lender will ask you if you've got new debt, but as far as your credit goes, in order to give you a thorough mortgage review and to determine eligibility for like these Home Ready, Home Possible Advantage, VHDA program, the lender has to run a credit report. So the person needs to be ready. Again, we share that information, and we adjust the price and the cost in the loan program to meet the person's needs and goals, because again, you can see how drastic you can reduce the investment with a Virginia housing loan, and you can also see lower investment for, even if you don't meet the requirements of a Virginia housing loan, the Home Ready, Home Possible Advantage might work for you too, without you having to wait. This is a key thing: wait, have property, the sales prices go up, or have the rates go up. Right now, good news: the rates have stayed lower, and the likelihood of them going up before maybe next year, maybe they'll stick around in the ranges of what we have, but eventually they could go up, and that will increase the monthly mortgage payment that you have to pay, and for some people decrease the the sales price that they're qualified for. So there is a cost to waiting. I know that if somebody's coming off a lease, like you've got a lease now, or if you own a home, the timing of the purchase, the lender can help with that, about strategy. Because if your lease, let's say, ends on October 1st or the end of September, you ought to be out looking right now, to match the the settlement date. If it ends the end of October, end of November, December, or next year, then you've got some breathing room. But I have had, just in markets that there haven't been a lot of listings, that it takes a little bit longer sometimes. And don't be discouraged if you're in a very competitive market and you don't win the offer. I have clients that easily have made 10 or more offers, and they just wait till something comes up, but they learn along the way what the best strategies are. And as the loan officer, of course, we want you to look the strongest too, and the review to be accurate. So a lender, if they say you're good, there's not situations that hadn't been looked at. And there is times when somebody has to do some extra savings or some credit repair, kind of work out some situations. That can be planned. If you don't have a house yet, the issues are, if you just go out house hunting and then you haven't done this part of it, you'll have a much better experience if you do the loan review in advance. I recommend 30 to 60 days of serious house hunting is key. And again, the lender typically, there's not an obligation with that or a cost. you don't have to collect money. So anybody who wants to collect money, that's suspicious. But you're not locking in. It's just to be determined, sort of a prospect. And there's good information out there. And it may be that the market's turning a little bit and may be more favorable to buyers. I mentioned what I've heard is that the condo market has more listings. And that's great for these programs because, when you're working with 525 sales price limit, it's in some areas that's going to be a challenge, but in other areas it's not a challenge. So that's kind of one of those things to look at. I mentioned if you buy a homeowners association, like very common in townhouses or condo, part of what you have to look at is the documents, like the condo documents or the homeowners documents, to make sure that they agree, with your lifestyle. There's nothing on there that would prohibit you from living there. The fee for those items is not in your monthly mortgage payment. You pay those directly to the association or the management company. And that for a condominium, we have to approve that it's acceptable financially. So the conventional mortgage program, if you put down at least 10%, then there's a way to waive reviews. But it's not any big deal. It's just that the lender, in addition to qualifying you, the buyer also has to verify or approve the condominium that you're purchasing, that it's acceptable for Fannie Mae or Freddie Mac financing. So I know time is kind of rolling here, but homeownership, again, the advantages are that you control your ownership and where you live, so you don't have to move as when the landlord decides to sell or do changes. You own it. You don't have to wait. These programs are no wait. Like you all heard, know exactly 1% of the sales price. You can maybe buy a home. So much sooner than you might have thought. And you build equity with every monthly payment, and you have the appreciation that occurs, in this market. You also have the risk of the downside, but if you bought a couple years ago, you'd be pretty happy with the appreciation in most areas that you had. So this enables more people to buy, whether it's Home Ready, Home Possible Advantage, or VHDA, Virginia Housing, sooner, and at a lower monthly payment, because we mentioned that the interest rate is lower if you're eligible, and the mortgage insurance is lower, and the down payment is lower. So all those things are an advantage and good to know about. And there's web resources. I mentioned VHDA.com is where I find all the info for VHDA. If you want, you can take the home buyer course in advance of buying, and I believe it's good for 90 days, but it might be longer. Home Ready, Home Possible Advantage, you just look up like Home Ready Fannie Mae or Home Possible Advantage Freddie Mac, and they both have a lot of information on their websites too, as far as buying and eligibility and preparation. If I'm not getting cut off, my preparation talk is quickly income. Self-employed people need to be able to document 2 years. So if you're self-employed, even more important to get the mortgage review, and if you haven't filed for some reason for 2020, you'll need to do that, and hopefully by electronic submission, because the IRS is taking a little longer. So self-employed, 2 years. If you switch jobs, you need to document that you've done that, and it's in the same amount of work, and it's a salary, full-time position. Typically have to be started and have a pay stub prior to home closing. Money, you need to show 2 months of bank statements. So make sure that there's not deposits that are not explainable. Your pay deposit, that's totally fine. But 2 months of bank statements are typically looked at. Credit, 640 credit score at least. And the lender can determine if that needs to be anything improved. But the higher, the better. The highest scores I typically ever see are in the low 800s. Average, is probably low 700s to 780. But you don't want to buy something big before you buy a home. And then once you contract to buy a home, then you you don't want to take a loan out before settlement. So keeping credit quiet, paying the monthly payments on time, of course, but not, if you're preparing to buy a home, not the best time to buy get a big car loan payment, things like that. Student loans, I wanted to remember, a lot of loans don't have a payment, and we just have to document that they're in a forbearance status. If they're a federal loan, I think that they extended that. So it may be that lenders don't need to count that monthly payment. Maybe they do, and typically the Freddie Mac is 0.5%. So 0.5% of the balance of the student loan is what might be counted for in that debt ratio we talked about, 45% or 50. So another reason to get mortgage review, if you've got student loans, those can be a little tricky for qualification at this time. But as far as credit goes, keep your credit quiet. Don't buy something super expensive. That would probably be all covered in the home buyer education, but also good to know as far as how it goes. Again, cash. If you're planning on getting a gift or something like that, again, the mortgage review can determine how much you need. But then talk ahead of time with your relatives. Again, it should be really parents or brother and sister. The farther it gets out, the more the lender has to check out if it's going to be okay. Because cash is not, nobody knows where that came from. So that's typically not going to be an acceptable form of money to use for the transaction. The gift is something that I advise my clients to make sure that they have it in their bank account at least about a week or a week and a half before closing. And the person who's going to give the gift, let's say parents are going to give a gift, and they can give the whole thing if they wanted to. They fill out a letter that they're giving you a gift toward the home purchase, and that's part of your loan file. And then at least a week to a week and a half before closing, you verify that you received that gift in that amount, and it's on deposit with your bank and what the updated balance is. So a little documentation there for the gift, but it's acceptable as money for your down payment. So good to know about. 401k, same deal. Somebody might not realize they have that resource as funds. They might go, well, I'm short the 1%, but then they look at their 401k, and you want to be careful about this. You don't want to liquidate your 401k account because you have tax consequences. But if typically it's your employer's plan, it's not one that you left your employer and now it's just by itself. It's usually going to be the 401k from your work, and it might have a loan program. You could borrow, 2,000 or 5,000 and have a low repayment on that. And it's just another source of your funds.
Hey, John, I just want to let you know that we have a couple questions, and
okay.
Since we're right about it,
I'm there.
Yeah,
sure.
So I know you have a couple slides left. I just wanted to make sure that no one else had somewhere else to be. So I just want to make sure we can get there.
Yeah, no problem. I'm pretty much just open for questions.
Okay, sure. I didn't know if you had anything else you wanted to go over. We're not going to be cut off by any means, but I just wanted to make sure that she would still be here when we answered her questions. So here we go. Do these programs work well for self-employed individuals?
Okay, for self-employed, I was mentioning it's a little tricky. So one key thing is the person, let's say I had a consulting business, can document that they've done it for 2 years, and the income that's used is the tax returns. So it's always a little scramble because a lot of self-employed people file extensions. So the key thing now is that you've filed your 2020 tax returns and that they will be transcripted, and that can take a little bit. So the other requirements, and these are I would say that they're pandemic COVID related self-employed requirements, and they have not been lifted at this time. Before closing, on a person who is employed, we get their most recent pay stub. For the self-employed person, we've got those 2 years of tax returns, verified 2 years. A lot of times we just average the last year's tax returns from the Schedule C. So your lender should be able to figure that out. You look at the Schedule C or the partnership or the corporate, and there's a way to calculate your income. But it's good to do it in review so you have it ahead of time. But you also need to prepare, and it can be hand prepared, so it's not audited, but a hand prepared profit and loss statement year to date. So I just had one, and the lady prepared a profit and loss to the end of July. And her business didn't really have assets, so there was no balance sheet. So we just had her write that she didn't get a balance sheet. If the business had assets and there was, a balance sheet, then it would be a balance sheet too. The self-employed person usually signs that. And then the last requirement for the self-employed person is 3 months of bank statements, because I mentioned the normal loan requirement is at least 2 months of bank statements. Self-employed, you need 3 months of business bank statements to show that the business is open and is receiving revenue in the range that you use for qualification from the tax returns. So very good question. Self-employed people recommend the mortgage review to determine just how they're going to be qualified.
Wonderful. And just a reminder, if you do have a question, on the right side of your screen is a question mark button, and that's where you can type a question if you want to ask one. Okay, so the next question is, what happens if you had to take unemployment because of COVID?
Lenders understand that there's circumstances last year. The mortgages, you have to put down 2 years of the person's employment, whether it's salaried, full-time, self-employed, and also unemployment. It depends on the length of the unemployment. It's called like a gap. So if the gap was 6 months or less, that's fine. The unemployment income is likely not to be considered as part of qualification, but that's a satisfactory explanation for a gap of employment. If the gap of employment was longer, like a year or more, then the lender just has to determine if that's going to be acceptable for having 2 years of employment. But it's not a disqualifier. The pay stub requirement, last year some people are getting furloughed or getting reduced hours. I'm not seeing that as much, but that was the reason for the pay stub. Self-employed, of course, some businesses could not be open, several months of last year. So there was no way they were going to be able to show revenue coming in on their bank statements. So that would be a challenge. But again, fortunately, there's a lot of places that have recovered. But does that answer that question?
I believe so. And if it doesn't, feel free to submit a follow-up question. All right, and so
Sure.
I have 2 last questions for you. They're very, very similar. So I'm going to read them both to you. And so
Okay.
One is, what if you were not currently a Virginia resident? So maybe they were never a Virginia resident at any time. And the other one is, are these programs available to people who are seeking to move back to Virginia but do not live there currently?
Got it. That's a good question. So as long as you're buying a program in Virginia, that you can use the Virginia housing. So you could be moving from another state. Technically you could have owned a home as long as it wasn't, within that 3-year time period. But if you're moving back into the state, you don't have to, the key is home ownership is still important. If you lived in another state and had home ownership, then that would be an issue, that 3 years. But coming in, as long as the home you're purchasing is a primary residence in Virginia, and for Virginia housing, you haven't owned a home in the last 3 years. I mentioned Home Ready in the other program, Home Possible Advantage. You could still own a home, let's say in another state, but now you're going to buy a residence here. You could still be eligible for the program if you meet the other requirements.
Wonderful. Yeah, she says you absolutely answered her question on the one before this. So that was great.
Okay.
I'm not seeing any new questions come in. John, thank you so much for joining us.
Sure, it was a pleasure, Cameron.
It was indeed. All right, take care. Again, these videos will be available on our Facebook at 2 p.m.
Sounds great. Thank you very much, and good luck on your home purchase.